Hey everybody, Boris last with BK Forex. Welcome to the weekly technicals for the majors for Euro dollar, dollar yen, pound dollar for Jan 29th to Feb 2nd, 2018. And what an unbelievably volatile week it's been. My head is reeling. I think we've had more volatility this week than we've had in years. Literally, there was months where we haven't had the kind of volatility that we've had in days this week. My view that the dollar was going to the anti-dollar move was going to stall last week was clearly wrong. We blew through every support level we could. And as a result of it, dollar slipped to multi-year lows by the end of the week. But I'm going to try to sing the same tune again this week, at least at the beginning of the week, simply because when you're looking at the charts just screaming oversold and screaming a little bit of correction on the euro, the pound, and perhaps even the yen. We'll take a look at all the charts in just 1 second, but let's set ourselves up for the week and just kind of review how everything went. First of all, euro blew through all the levels and now took out the 25. 25 now is acting sort of as a mild resistance to the euro. 23 is support. Yen sliced like a hot knife through 110 and actually came all the way down. This is really going to be very critical as we look at the charts. This 108, realistically 107.50 support is going to be just absolutely vital to see if the dollar can preserve any of its strength this week coming. And cable took out the 140 like it was nothing, and now 143 is resistance, 40 is now support in cable. So looking at the calendar next week, the calendar is actually quite full of data. Even though we've had tremendous amount of volatility this week, I don't think the data is going to give us any respite. We have we started the week with relatively quiet majors data, just sort of personal income, personal spending stuff. On the U.S. side, we have consumer confidence, and then we get into Wednesday. That's when we get into the thick of things as far as U.S. data. We have the ADP numbers, which is going to telegraph how strong or weak the employment numbers are, which are the absolute marquee event of the week into the final week. And then also we have the ISM numbers. On UK side, we have UK manufacturing data. We have ISM manufacturing data on the US side and UK manufacturing data on the PMI side on Thursday as well. And finally, Friday, everything comes together with the non-farm payrolls report. A couple of things, of course, very critical here. First of all, when you look at the non-farm payrolls data, we've actually been below 200,000 for 3 months in a row. And this whole idea that the pro-dollar trade rests on the assumption that we're going to get better than 3% GDP. We already had negative GDP this Friday. It came in at 2.6 versus 3.0. And if we don't get the kind of growth in jobs that the market is looking for, it's going to be very difficult to imagine that GDP could grow that fast without the engine behind it. So the jobs number this time becomes actually even more important, because if it comes in paltry like 140, 150, that would really suggest that we may have peaked in our job generation. At the same time, while we have not really picked up any significant wage growth. So all of this really puts a much stronger onus on the Fed, which, by the way, I forgot to tell you. Sorry, let's come back to this. Wednesday is also FOMC rate decision. It's not a big deal because nobody's expecting any rate hikes, but still it'll be interesting to see what they say and what they do. Yellen's last FOMC meeting, so it's not expected to be a big event, but it'll still be interesting to see if they change their tone at all. So quite a lot of data this week for U.S. It's really very U.S.-centric. Europe just kind of takes this, back seat a little bit, and UK has a modest amount of stuff. There's also a Carney speech middle of the week that I think will be important for the UK data set. But overall, really, no rest for the weary as far as the FX market, in my opinion, is concerned. Let's look at the charts here and just kind of see how everything sets up. So you look at the euro. This is a weekly chart. I mean, it's a very strong double bottom W bottom. It certainly looks very bullish from a long-term point of view. But let's take a look on a more granular level, because this is why I am going to argue that there is at least 100, maybe 150 points worth of correction here somewhere in the euro at the beginning of the week. If you look at the euro anytime on the charts where it makes a shooting star candle, that is a flame out candle, takes the highs, ends at the lows kind of a thing, right? It almost always is followed by some kind of a corrective move. Sometimes it's small, sometimes it's more significant, but it's generally a very decent signal for some sort of a corrective move to happen. And that's primarily the reason that I'm arguing for this. It's not a question of fundamentals. Fundamentals have kind of gone out the window because we are so extremely overbought that you can argue till cows come home. It's just if anybody told you at the beginning of the year that the 10-year US would be at 266 and dollar yen would be below 109, you would say they were crazy. And yet this is how we stand because of the sentiment moves that we've had in the FX market. So if we are looking at some sort of clues on a text, this is perhaps our best shot at the idea that some kind of corrective move is due for a small, maybe 150 point move. So I would be trading against the high here, which is, let's say, 25.50, on the assumption that we don't take it out. If we do, all bets are off. It's just an insane rally, and you just stand back and shake your hands or shake your head. The yen is a little bit more problematic, but still offers a pretty decent risk-reward ratio, because if you look at the charts here, the spike low 107.31 is really the operative stop point against which you're trading on the charts here. So is it possible for yen to kind of re-rally back up? Yes, of course. Now 110 becomes like cement ceiling resistance. That was former support. Now it's going to be very, very hard to overcome it in one big fell swoop, especially after very, very anti-dollar rhetoric from U.S. officials that the market had just took very seriously. So really, today's action certainly not heartening for dollar bulls. If you're looking for any kind of a signal that this may have bottomed, it really didn't happen today. The only small source of solace you can take out of this whole idea is it didn't really make very strong, fresh new lows. The low on Thursday was 0850, and the low today was 0820, basically 25 points of more lows. That shows that there is, the selling at this point is kind of done, and maybe we'll have a little bit of a retrace back. Certainly 109 is going to be the first level of resist, and ultimately the 110. You really need some sort of a catalyst to create a short covering squeeze, but we are setting ourselves up for a pretty massive short covering squeeze sooner rather than later. And cable sending a similar signal. There was a more or less of a flame out at above the 143 level. We turned today. We ended up just a little bit better, but it's still pretty much a shooting star candle. And again, it suggests that maybe we kind of trickled back. 40 now, which was former resistance, becomes super strong support. So it becomes probably a buy on a dip at around 40, unless Carney just decides to destroy cable somehow. So that's how the week shapes up. As I said, no rest for the weary. Lots and lots of action next week. But tactically, I think the right approach is to try to pick tops here, something that's very dangerous to do. But at this point, we have definitive, clear risk parameters against which you can trade on the charts, and those are as reasonable as anything that you can do in the market right now. Wish you guys the best luck, the best of trading. Boris, over and out.